Good morning. My name is Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm John Darsie, Editor-in-Chief, and together we bring you the morning call on a windy day here in New York. And we had to sort of fix up our hair a little bit before the show after the wind got us this morning, but we're good to go now.
Lucky you're not a chick.
Yeah. So this morning we're getting, futures were down a little bit earlier, now they're around flat to slightly higher after yesterday's small bout of weakness. Yesterday you would have thought the market crashed based on everyone's reaction to that. You know, the S&P was down just about 0.4%, but it's the biggest gut check we've had so far this year.
And it's funny because every time you do go down, everyone's like, it's over, it's over. If you remember over the course of the past year or two, or in the last decade, you'd have a Fed day and the market would swing 150 to back and forth. There'd be volatility. Yesterday, I think, during that hour, it was up or down 20 points, and I felt like, oh my goodness, this is getting a little crazy, when meanwhile, there really wasn't that much of a range there.
Yeah, the big catalyst yesterday, before the open, we had the GDP number that came in very weak. And, there's a lot of different theories about why that happened. There's the weather. We had Hurricane Sandy. Some people think that the GDP was goosed heading into the election to sort of win the election, but we'd never make an accusation like that. The Fed tried to say that, weather sort of put the economy on pause and that we'd resume to the upside, but there's no guarantees. And the Fed announcement yesterday did nothing to really change expectations. They continue to tie everything to employment. What did you make of those?
I just think there's a lot in there. It's also behind us. So all those things hopefully are behind us. The election's done. Physical cliff argument back and forth is done. Hopefully we don't have another Hurricane Sandy. So, in my opinion, I think that, 2013 is going to steal a little bit from the GDP that should have happened in the fourth quarter. So at some point this year, we'll get better GDPs. So that one is hopefully the worst that we will have seen. And the market took it in stride. The market's been taking a lot in stride, and everyone's trying to put out their opinions, put out their, their thesis. And so many people yesterday, like all the bears out there, like claiming victory, like, see, I told you so. Meanwhile, they didn't buy anything on the way up this year and missed out on a lot of the gains. So at this point, it's really the action is truth, and we'll let it speak for itself.
And then Friday, obviously traders will be watching for the jobs report. With all this focus on employment and everything, that'll obviously probably be a market catalyst. So yesterday, for In the Trenches, we're going to go into a couple sector ETFs that sort of gave us some clues yesterday that yesterday's move in the S&P could lead to a little bit more downside. And the two indexes I'm talking about are the transports and the small cap Russell index. Scott, what did you see in those two ETFs yesterday, the IWM and the IYT, that leads you to believe yesterday's S&P could be the start of a little bit bigger of a pullback?
A little bit bigger of a pullback. I think that's the thesis, is where is it going to go and how can it get there? And as a trader, you never really know. You just have to look at leading indicators, and the transports and the Russell has been the best one because they've been the strongest. Every time they've made new highs, some sectors would then follow suit. When they broke out, maybe a day or two later, a sector not as strong would do so. So when you get the strongest two sectors have a bit of a pullback and give into their 8-day moving average, which we talk about so much, it gives us a little caution. So yesterday, for me, it gave me a little caution where I took down some position size. I added to some of my spider hedge, all based on the fact that if you look at the chart of the IYT, there are always entries and exits, and you have to time these things. This is that long channel. This is when, you get really excited right around here, because this is when you can get into a core position, when it breaks out or on the retest or even on this gap up. So then you stay with it and trim and trail it as it goes along the 8-day, and then finally, it broke an upper level. So in perspective, not really much to worry about if you're a macro investor, if you bought in here or whatnot. But as a trader looking to time things, you broke an upper level, you closed on the 8-day. So now what do we know? We know yesterday's low. Yesterday's low is right here. So we'll see, does it hover by this for a day or so, or does it get below 102.55 on its road down to the 21-day? So yesterday, breaking this upper level gave us some clues. Same kind of thing for the Russell. All right, you look here, same situation. Here's your igniting bar. Here's when it gapped above the September highs. Spiders and the S&P just got above the September highs recently, or in the last week. This did it on the first day, showing you leadership. From here, followed the 8-day moving average. So you take a little bit of a look closer, and you'll see finally, it let it break a few levels here. So at this particular point, draw a line on your charts right here, write down yesterday's low. Yesterday's low on the Russell is your new pivot. That's how we get pivots, 88.69. And if it can't take back this area, relatively soon, then you could take out the low and then see a move down to this 21-day moving average, which I do think will be an area that if you are still short, if you are short this, to cover and maybe look for a buyback.
And continuing with the theme of sector ETFs, we saw the industrials, which is another sector that's been leading the market higher this year, closed basically right at its 8-day moving average. So the jury's still out on whether or not the complexion has changed with that ETF.
Yeah, well, there are a few that haven't done it yet, so that's why it gives you a little bit of a leading, like the leading indicator or the leading clue is the transports and the Russell. So when you look at a group that has also been strong but not like as blockbuster as those other two, you want to see, do they hold up or do they follow suit? So if you look at the chart of the industrials, you will see, here's the beginning of the year too. This also, was well above the September highs on the gap up of the new year, showing you relative strength. From there, here was your test of the 8-day, and that was all it was. It didn't break, and then it followed it all the way up. So here we are, broke below and closed on its lows. The first time you've seen that, right? So you want to see or judge if anything's a little different. Here's something a little different, not extreme. So here we go again. This is your little line. So if it can't get back above, just say 40-40 anytime soon, if it breaks below yesterday's low or this 8-day with any kind of velocity, you could see a move back to the 21-day moving average, which I do think will be healthy.
And then the last two ETFs we'll talk about are the home builders, the XHB, and the financials, the XLF. Those two have just sort of been choppy at highs, which is sort of a caution sign for us. Do you think, or are you still waiting to see whether those break their 8-day, or are you sort of leaning one way or the other?
I'm watching those two, but before we get to those two, I just want to show the spiders, because the spiders, which is really the indice or the ETF that I use as a hedge or I buy it at certain times. Just to show you where this is, it's not there yet. Okay, here is your 8-day moving average for the spiders. So I want to show you clearly. So the spiders, which has not been the leading ETF or the laggard one, it's been kind of in the middle, had its first little day where it closed near the lows, where it hasn't been able to do that, or with a red bar during the course of this year. Here is your gap up, here is your sideways, here's when it broke above that 1474 in the SPX, that's 148.11 there. So for me, when I saw the weakness in some of the leaders, I got a little bit more short the spiders, okay, especially since it did a little push through failure. 150.85 was the prior day high, pushed above it, and then only made a small high by 10 cents. So I did add to my shorts as it went back below it. Covered a little bit on the close. I still have more than I've had, pretty much during the course of this move. And the question is, will this break this small ascending channel here? Will we break below the 8-day, the 149.50? And that's why I'm watching all the other groups, especially the leading ones, because if it breaks that, we could see a move to the 21-day, and that 21-day to me is very, very interesting. That's where I think you try and get back into some core longs. So right now, yesterday's low is 149.93. We were below it this morning. We're probably right there now. So that's your pivot support. And I guess we'll have to see what happens in the jobs number tomorrow.
All right, we'll change course a little bit and go into some earnings last night as we go in the trenches. Facebook last night delivered a report, and expectations were running high after its recent rally. The report basically came in line, but the street wasn't terribly impressed or impressed enough to keep it at upper levels. Do you think this is just a transitory pullback for Facebook, or do you think it's the start of a little bit of a bigger correction?
Well, we'll have to judge each level. I personally don't think the highs of the year are in for Facebook. Problem is the analysts. When stocks started to move, everyone wants to up numbers, up numbers. I hate to say that's what we saw with Apple. When Apple came out with the iPhone 5, every analyst was like, oh, they could sell this amount. No, they'll sell that amount. No, they'll sell that amount. Then finally, when they came out with their numbers, it was a disappointment, not to the company, but to the analysts. So anyway, with Facebook, we've had a big move. The low is September, the low is around 17, and then it became a nice trade right around here. If you take a look at the chart, you will see this is when the shares got locked up or unlocked, and it rallied and then held here. This was that trade I talked about around 24 to fill this gap. It then filled the gap, put a little bit of a high in, and then it needed to consolidate. And then from here, made another move, gapped up, broke through resistance, went up into that invite-only type scenario. So it being down after earnings, I don't think is such a big deal. I know last night after hours, Sperling and some of us, we were playing it in the 28 area. So this was your low, right around 28. So I would say if it could hold around 28 and you want to nibble there and you didn't take it into earnings, I think it's a good idea. And at that particular point, if it could, put some kind of reversal bar in off the low, then you'll have something to trade against. But again, in my opinion, I don't think this is the high. It's just going to need some time now to work off what's been a really, really nice move. But before we get into the rest of the earnings and the quick hits, I think we're being told we need a commercial break.
All right, quick commercial break. We'll see you in a little bit.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
Welcome back. So yesterday we saw some interesting action in Amazon. The night before it reported earnings. They sort of missed on a lot of metrics, but margins were improving, and that's the story that a lot of analysts were looking for. The stock gapped up, but closed that 9% gap within the first 40 minutes of trading. Do you think that's a big caution sign? Do you think that's just healthy action given where Amazon was on the chart?
Well, it just shows you that you have to have a plan. I think we talked about the pivot high, which was around 284. So the question was, could it get through that 284 and do another short squeeze, or will that be resistance to sell the earnings report, because entries and exits matter? And within the first 15 minutes, it was a much better short than a long. And then it found some support, but ultimately, I think now the stock needs time. It's definitely, if you look at the chart here, look at this wide range, and it's just, choppy / ugly. So if you remember, this was the line we drew. We said, okay, if it gets above it, it could squeeze higher, could even go up to as high as, 300? But if it squeezed above it, came back below it, that could be a short entry. It didn't get above it. I know for me, just real quickly, we caught a cute short here. When it opened up and then it couldn't get anywhere. It put in the pivot low right around here. I think that was a nice short entry. And then from filling the gap, it rallied back up into the resistance area, and then went sideways. So you go back to where we are now. Here's your range. I guess pivot support now will be yesterday's low. Here is bigger support, there's your resistance, but I think it's going to be somewhat of a choppy mess in here, so I'm probably just going to avoid it or just take some small trades back and forth.
And last night, Facebook disappointed a little bit, but we got 2 strong reports. The first one was from Qualcomm, which is up about 5% this morning after its strong report. What do you see from Qualcomm, Scott?
Well, if you're an investor in Qualcomm, congratulations. Maybe in the gap up, you want to trail some, or you want to sell some and then trail some. And as a trader, that's flat, kind of like I was in Amazon. I'm going to look at the pivot level to see if it could hold, to see if momentum stays there. If you're involved for a trade that requires momentum, you only stay there if the momentum stays. So if you look at the chart of Qualcomm, I know after hours some guys were trading it, and they said as long as it gets above, 65.50. They're going to buy it and stay with it, and it stayed above it, and I think it went as high as 67. So here's your line in the sand. If they try and sell the news, so to speak, in Qualcomm, then make sure it holds this area. If it holds this area, I think that'll be healthy, and then what we'll have is another gap, and then let it go sideways, and then we can maybe buy it versus that gap for future movement. So at this particular point, though, I would give it some time. If you do short it versus a 5 to 15 minute print, and then see how it handles this prior resistance, which now should become support.
Last night we also had a strong report from LVS, which had sort of had a small pullback after a great start to the year. It's opening up near pivot highs this morning. Do you think you can get more upside in LVS?
I'm not sure. So again, we'll let the market tell us. I do know from chart patterns, it's given us 2 nice trades. If you remember back over the summer in July, on an earnings report after a big decline, it finally put a capitulation low in. So it shows you that entries and exits matter. You go to the chart here. If you guys remember this capitulation low right here? It came in on a bad earnings report, showing you that it could be priced in. I need to show you the volume that day, because the volume that day was so tremendous that for swing traders that got involved there, they did really well. Because look at that volume. And look at the big move lower. You had a red dog reversal at the top right there, and then you had a red dog reversal at the bottom. Anyway, to start the year, you had a nice gap up, which resolved this channel. You had a channel here that was consolidating that capitulation low from July. Then to start the year, gap up. So it never filled that gap, showing you pent up momentum. So now here we are gapping up again. This level to me is 54. Okay, if it can get above and stay above 54, then potentially it sees a move where, when the market wants to get its footing again, back to the 60 area. But if it opens up and trades back below, this 53.94, to me it's going to tell me it needs time, and then I think some shorts will probably lay into it, and it could be a good short trade. But for now, that is your pivot level. Give it some time to see if it can open up above and hang above it or not.
We'll finish off the show with some quick hits this morning, and we'll take a look at our old favorite Apple, which is trying to bounce off the lows. It can't get momentum like it used to, but it's still holding up after a gap up yesterday. Do you think Apple can get a little bit more upside?
Well, this will be an interesting time, because if we do see a little retracement in the indices, can Apple's complexion change? Can it hold higher? Can it be a little different? So I actually held Apple for 3 days, first 3-day hold in a while, considering it hasn't given you a reason to hold it 3 days long. But I did sell some and exited yesterday in the weakness of the afternoon. So I'm going to be looking to see if I can buy it back. If you look here at the chart, you will see that, here is that reversal low, which came into that gap all the way back from here. Remember back here, this was your 440. You go across, we went as low as 435, so it did hold some of that gap. So you go all the way through. That's what we were looking at there. So now fast forward to where we are now. If Apple could stay above, let me get that little line because you know how I like my lines. What is this, 452-ish? I do think that would show some commitment to this bottom bar. Okay, and then if we hold above there after a little bit of time, perhaps we get a nice juicy trade above 462 to 465 to fill some of the earnings gap that could take you to about 483, and if not a little bit higher to the 21 days. So right now, here's your inside range. I'm going to take this day by day. Let's see if it can go positive today.
Yesterday, we also had some choppy action in our other big tech favorite, Google. Do you think the action we saw yesterday in Google is a sign to take caution?
I wouldn't say time to take caution, but it just lacked momentum. And that's the problem that a lot of us have been having is even though we've been going higher, buying high and selling higher, which is something we love to do as momentum traders, has been hard to find. And even in the best stock like Google. So yesterday, when it traded through 458, it went to about 460 or so, but then it didn't have the momentum. So you look real quickly at the chart. I'll buzz right through this. Here is that level we thought maybe it can get above and hold, and it just couldn't yet. It's still above all the moving averages. It's still above the earnings gap. So for macro investors, still looks good. For intermediate traders, I would say as long as it stays above 744, let it go sideways. It should make another attempt at that level, and hopefully next time momentum stays.
Bonds were in focus yesterday surrounding the Fed announcement. We had another uptick from TBT. Do you think that's a trend that is going to continue?
I think it's a choppy trade, that trade, and you have to really love that thesis. For me, I'm trying to like the thesis. I'm trying to stay with it. I was in it earlier in the year, made some money, got choppy, got out of it. I think last Friday got back into it, and then yesterday, I still have it, but I sold the majority of it. If you look why, I thought maybe the Fed would be a catalyst. You had big resistance right here where it somewhat failed at. So, and then it closed it as a doji. So I'm still in it. I think maybe it tries to pull back a little bit, but ultimately, this trade, in my opinion, continues higher. You just have to either have a macro approach where you don't look at it that close, or trade around it. And on this gap up, it was a nice entry. On this doji, it was a decent sale. So I'm going to manage this position. I say as long as it holds above, just say now 66.51, I will stay with this as one of my longs in my portfolio approach.
Finally, gold also often reacts to Fed announcements, and yesterday it gapped up and held relatively well. Is there anything compelling with gold now, or is it still out of play for you?
Still so choppy, and I think the gold bugs started to raise their eyebrows, like, oh my goodness, this could be it. But not yet. Sorry, but you now have points of reference. So here we are with this chart. You still have a huge descending channel, but what do we have now is a small gap up above some of the moving averages, so it gives them some hope again that finally maybe it breaks this big downtrend and blasts through, and that's what you need. So if you are long gold, I would say short term, use 162 as your stop. If you are a macro gold bug, so to speak, and you've been in this for a while, here's your really big support, right around 158.5. And if you're a trader looking for momentum, it has to get above this 164.40, close with some authority and change, which it hasn't done since the high here, in what is that, late September, October-ish.
All right, well, that does it for the full morning call. Join us on the VTF for what should be an interesting day after a little bit of weakness yesterday. We'll see what it leads to. We'll see you out there.